Hey, this is Nick from Income Digs. Welcome to this video tutorial where we show you the exact tools we use within the world of real estate investing. Today's video is a long time coming, a lot of requests for this, and appreciate the patience. We're going to continue on with the series of real estate accounting. If you haven't yet watched the first 3 videos in which we demonstrate how to record a journal entry for the purchase of property, I recommend you do that first. But once you've done that, we're going to carry on with our accounting, and we're going to take a look at how we would go through actually rehabbing a property and accounting for that, and then also getting draws from the bank. Okay, so a lot of times what happens is we'll purchase the property. For example, I have 123 Main Street that I purchased for $100,000, but I have the intent to rehab it. So we're going to show you how we would account for those rehab items in our balance sheet here, and also how we would account for getting draws from a bank. So I have a loan on this property, and this was just for the purchase, but I have an agreement with the bank that as I complete work on the project, they're going to give me some money for that in the form of draws, and it's going to increase my loan balance. All right, so we're going to demonstrate those 2 things today. To dive in, let's pretend that we did some renovations on this property. Okay, so you can account for those in many ways. I mean, one way is that the expenses would come into your banking. Okay, that's possible. You could also just add expenses. So let's go and do that. Let's say that we had an expense, and for just the purposes of the video, I'm going to make all these 2015 so that they hit our balance sheet report the right way. All right, so who did we pay? Let's see, who did we pay? Let's say it's, I don't know who I have in here. Let's just pick somebody. Let's say we paid Amazon. Okay. So the first thing we need to do is indicate what account that is. Now, I probably don't have the account set up yet, but basically this is going to be an asset account, okay? So when you rehab a property and you're adding value to it, you're doing a capital improvement, that goes into your asset for most cases. Of course, consult your accountant, your bookkeeper to confirm, but as you're doing something, say in this case, we're going to be doing a roof, that's going to add to the value of your property and therefore should be added as an asset as opposed to an expense, okay? Now, I don't have this account set up yet, so I'm going to set it up right now. And what I want to call it is 123 Main Street Capital Improvements. Okay, now I don't have it set up yet, so I'm going to click Add, and then it's going to bring me through and ask me how to do it. So it's not an expense, it's an asset, it's a fixed asset. All right, and it is, it's going to go under buildings, and it's actually going to be a sub-account of the property. Okay, so 123 Main Street. All right, now we can track depreciation on these. I'm not going to get into that yet here, but we'll want to in most properties that we're going to own for longer than a year. So a rental property, we would want to do that. If we're doing a flip, we don't intend to own it for very long. We're not going to track depreciation against it. All right. So save and close. So the account is created. I'm going to say new roof. Okay. And this cost me, let's say, $25,000. Okay. So it's going to come out of my checking account, and it's going to add value to my assets. So save and close that. All right. So let's look at the balance sheet now. So my checking account went down by that $25,000, but you see what happened here is that we added value to the capital improvement section. Okay, so my total value of 123 Main Street is now $125,000, as opposed to just that $100,000 that I purchased it for. Okay, and that's how that works. So you see that my actual equity in my business didn't change at all because as I spent money, it added to my assets, okay? So that's how we would account for an improvement, and we can do another one quickly. And let's pull up Amazon again. And let's say this is on 7/21/2015. Now it pre-populated this account, capital improvements, great. And let's call this, let's do siding. All right, let's say that we spent $7,500 on siding. save and close, and it'll adjust things accordingly. So now the value of that whole asset is 132.5. Okay, so we spent some money, and now it's time to request a draw from our lender. Okay, we have this loan down here for $75,000. That was for the purchase, but we also have an agreement with the lender. Let's say that they're going to issue us another, maybe $50,000 within 3 draws. Okay, so we would have established this before we closed on the loan during our negotiations with the bank. We would provide a scope of work, and we would say we're going to purchase for $100,000. We're going to put $75,000 into it, and we're looking for a loan, $75,000 for the purchase and another $50,000 for the renovations. So a total loan of $125,000. That's what we're looking for. And maybe they'll agree to that, and then we'd set up some kind of draw schedule such that when we complete some work, they're going to give us some money. All right? And let's pretend that draw schedule says that once you complete the roof and the siding, we'll give you $20,000 of that $50,000. All right? So we need to account for that draw. We can do that in a few ways. We could do a deposit. I tend to like doing journal entries for those, but because they're so rare, journal entry is not too cumbersome. So we do a journal entry, and let's say that the draw comes from the bank on the 1st of August. What we're going to do is that check is being written to our checking account, right? So Income Digs checking, we're going to be debited $20,000. Now I did mention, I verbally said the bank, this could be a private lender, this could be a bank, whatever it is, doesn't really matter. Okay, so the checking account will be debited $20,000. Our loan is going to be credited $20,000. All right, and save and close. Okay, cool. So the loan went up, our cash went up. All right. Now there's another way that we could do this. We could do this such that the loan, now remember I said it would be $75,000 plus $50,000. It'd be $125,000 total. What we could have done was the bank might want us to pay interest on that $125,000 from the get-go. If that's the case, what will happen is the loan would be $125,000 on day one, but that extra $50,000 would be sitting in some kind of escrow account up here. All right. I'm going to show that real quick. All right, so I'm going to take this. I'm going to delete that first draw. We're going to add it later. All right, delete. And then I'm going to go to our original journal entry, and I'm going to say that this loan, this is the journal entry when we purchased. This loan is worth $125,000. Okay, but the other $50,000 went into a different account. We'll call it 123 Main Street Loan Escrow. And that's a new account. Doesn't exist yet. It's let's just put it in other assets. Doesn't really matter. $50,000, it'll auto-populate. All right, so if that's the case, what does our balance sheet look like for all this? So now this is assuming we haven't gotten the draw yet. So the loan is $125,000, and it will be like that for the whole time until we start amortizing it and paying it down, right? The escrow for the loan is sitting here. It's not in my checking account yet, but it's sitting here. It's an asset because I have the loan out. Now let's do that same draw, but instead of pulling it from the loan, we already have the money. It's just sitting in escrow. We're going to move it from escrow to the checking account. All right. So let's do that. Let's go journal entry. And again, 8/1/2015. It's going to come into our checking account. And this is $20,000. And it's going to come out of our loan escrow account. Okay, save and close. And you see that our checking account has increased by the $20,000, and our escrow has gone down by the $20,000. And this is probably the more typical way that the bank or the private lender will do it, is they'll have the loan out for the total amount, so you're paying interest on this the whole time, but you don't have the cash quite yet until you show that you've made progress on the build out. That's, sometimes they do it that way. Sometimes you'll only pay interest on what you've taken out so far. Okay, so that is part 4 of this process. Now we talked about rehab, we talked about draws. The last part of this series will be the sale of the property. We're going to show how to make the journal entry to sell this property and make some money and add value to our business. All right. So thank you everybody for watching, and please leave your comments and questions below. Thanks.